Alright, back in Module 5, I believe it was, there were some PowerPoint notes on Depreciation Basics, and you probably need to go back and review those a little bit, or just Google it. Wikipedia's got all kinds of good stuff in it. So, depreciation is basically when you purchase long-term assets or capital assets, you can't claim the expense when you first purchase it. Instead, you have to depreciate the asset over its useful life. And there's a lot of different depreciation methods that are used out there. Straight line depreciation is the most common, where a company takes the purchase price, subtracts the anticipated salvage value, and then that decline in value over a period of time, they just allocate an equal amount of the expense per year. So that's the most common method for financial reporting. For tax reporting, companies use what's called Modified Accelerated Cost Recovery System, or MACRS, and that's what's given in the problem we're looking at here. MACRS is meant to depreciate an asset faster than straight line depreciation, and sometimes it does and sometimes it doesn't. But the whole idea being is that you use this depreciation for tax purposes, which affects your cash flows. Okay, so what this firm is saying is that they have a $50,000 machine that will have a tax life of 5 years. Now, 5-year MACRS actually goes over a 6-year period. The first year's a half year, the last year's a half year, so you have half a year, 1.5, 2.5, 3.5, 4.5, and then plus a half year makes 5 total years. Accountants came up with that goofy rule. I'd have called it 6-year depreciation, but I'm not in charge. So the company is going to sell it at the end of the 4th year, and by that time they will have depreciated 83% of its value. So $50,000 is what they start with. They will have claimed depreciation of $41,500, which means that the book value will be $8,500. Okay? And if you're a little unsure on that, go back to Depreciation Basics and read through the PowerPoints on what depreciation expense is. Okay? So they're carrying it on their books for $8,500. This problem is asking you, what's the after-tax salvage value? Alright, so the after-tax salvage value would be whatever the salvage value is, and then plus the taxes on salvage. Alright, so the salvage value, they think they can sell it for $6,500. If you sell something for $6,500, which you're carrying on your balance sheet at $8,500, you're selling it at a loss. So essentially, the company takes a loss of an additional $2,000 of value. They get to take a tax refund of that loss of value. So if you take $8,500 minus the $6,500 they sell it for, they get to claim $2,000 of depreciation, and at 40%, that'll get them a tax refund of $800. So between selling the equipment and getting a $800 tax refund from selling at a loss, $7,300, and that would be choice C.